Hi, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and welcome back to The Pulse, where we take a month-to-month look at what happened in the economy and the capital markets so you make better decisions in your business and with your investments. Let's start with the highlights. Earnings and spending look better than expected, but markets are already pricing in fast growth. Rate cuts are expected, but inflation's still sticky and remains a risk. AI leads the charge while most of the economy does slow, and companies remain cautious about their hiring. Now, let's take a deeper look at the data, see what else we can learn. For August and the third quarter, stock markets are higher, with strength in small U.S. companies, U.S. tech companies, and developed international markets. For the year, all markets are higher, with developed and emerging international markets leading the pack. Bond markets are also up and have increased 4 to 6% for the year. Now, stock and bond markets reflect earnings exceeding low expectations, as analysts had been cautious in estimating company profitability after the April 2nd tariff announcements. Lower expected global growth due to tariffs have made commodities the weakest part of the market, with oil down double digits in August and year to date, while copper and Bitcoin have been mixed recently. Now, what these cross currents, what we see in markets are grappling with, are what we believe is the most important question right now. And it's looking at the recent economic data and wondering, is this a temporary deceleration, really reflecting a pause in decision-making after the April 2nd announcements? And we then would have the expectation that the economy would reaccelerate later this year? Or are we in the early stages of a global growth slowdown? Corporate second quarter earnings came in better than expected, very similar to what we saw happen in the first quarter. And that kind of broad-based improvement lifts markets. But the good news is already priced in, especially in large cap tech and AI. Valuations in those areas are assuming a lot of growth, which raises the bar for future performance. Now that compares to international and small cap, where valuations offer more value. Even in bonds, valuations are stretched. Credit spreads, which is the extra yield that investors demand to take on risk, for investment-grade bonds and junk bonds are the narrowest that we've seen in 30 years. Markets are not pricing in much downside. Now, across both stocks and bonds, investors are betting that the Fed will cut interest rates 4 to 5 times in the next year. That's a big assumption, and we believe asset prices would reset downward if that doesn't happen. Economic growth is still positive, but it is slowing. It's not a recession, but it's not strong either. And that mix of low growth and sticky inflation feels a bit stagflation-ish. New orders in the service sector, which is a key leading indicator, are losing steam. And that's often an early signal that the broader economy may cool in the months ahead. Meanwhile, inflation has come down from the peak, but it's not falling anymore. This plateau suggests that we're in a new era, one where inflation stays higher and sticky, which means that the easy money is probably behind us. Now, earnings across the economy highlight that it's AI versus everything else. The AI economy, which is here in orange, that's booming. But the broader economy, such as smaller companies, which we have here in green, has been treading water since 2023. And you can see how over that same time period, earnings for AI companies are up about 150%, driving the growth in S&P 500 earnings. Now, with growth slowing and costs rising, companies are more cautious. Hiring has stagnated, and employers are selective in how they're thinking about adding to staff. And yet, daily real-time data reveals that consumers keep spending. Against the odds, household demand is holding up, continuing to surprise economists and to support the economy. Now, consumers are being selective with what they purchase. For items sensitive to tariffs, essentials are holding up well, while discretionary categories like apparel, electronics, furniture, and sporting goods are seeing clear pullbacks. To sum up everything from today, here are the key takeaways. Markets are moving higher, but they're priced for almost everything to go right. Rate cuts are expected, yet inflation remains stubborn. And AI is driving the rally, but the broader economy isn't keeping pace. And as companies are signaling caution, especially around their hiring needs. So with that, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and I'll see you next time with our next edition of The Pulse.